A door closed on Wall Street in February 2026. Not a dramatic crash, not a headline. Just a quiet bureaucratic decision made in a glass tower. And the people on the other side of that door, everyday Americans who trusted this institution with their money, were told they couldn't have it back. Not today, not this year. Maybe in a few years. Sit tight. No breaking news alert. No emergency presidential address. No CNBC anchor with their hair on fire. The mainstream media covered it like a minor business earnings report. A few paragraphs, buried on page 12, gone by morning. And yet what was happening behind that closed door was something that had never happened at this scale in American financial history. $3 trillion, operating completely outside the rules your bank plays by. No FDIC protection. No Federal Reserve safety net. No bailout fund. And in 2026, it started breaking down because what quietly began inside Wall Street in 2026 may eventually be remembered as one of the most important financial warning signs in modern American history. Most Americans never saw it coming. Most Americans never even heard about it. To understand why this story matters, you first need to understand how your normal bank works. You deposit your paycheck into a bank account. The bank then takes that money and lends it out to people buying homes, financing cars, or building businesses across America. That system powers the modern economy. And for most people, the process feels almost invisible. Money moves quietly through the system every day. Paychecks arrive. Mortgages get approved. Businesses stay open. People assume the system is stable because it has always appeared stable. But underneath the banking system is something extremely important. A safety net designed to stop panic before it spreads through the economy. Your deposits are insured through the FDIC. The Federal Reserve monitors the financial system constantly. There are regulations, capital requirements, stress tests, emergency protections, and layers of oversight designed to keep the system functioning during periods of economic stress. If a traditional bank gets into trouble, the government has tools designed to stop fear from spreading everywhere else. That's the financial world most Americans believe they live in. A system built on trust, stability, and the assumption that someone is always watching the risks before they become dangerous. But over the last 15 years, another financial world quietly grew beside it. A world operating beside traditional banking, but outside many of its rules. A world Wall Street calls shadow banking, and most ordinary Americans have never even heard the term before. On the surface, these firms looked almost identical to traditional banks. They lent money, generated profits, moved billions of dollars through the economy every year. But unlike traditional banks, many of them operated with far fewer protections and far less oversight. One of the fastest growing parts of shadow banking became something called private credit. Private credit firms lend directly to companies instead of using traditional banks as middlemen. And after the 2008 financial crisis, the industry exploded in size. Blackstone, Apollo, Blue Owl, Ares, some of the most powerful financial firms on earth rushed into the business. Investors loved the industry because the returns looked incredible during years of near-zero interest rates and easy money flooding the economy. Everything appeared profitable. Everything appeared stable. And eventually, ordinary Americans became connected to the system too. Retirement accounts, pension funds, investment portfolios. Millions of people unknowingly became exposed to this hidden financial machine without ever realizing how interconnected it had become with the broader American economy. For years, the system kept growing larger, faster, and more interconnected. Money kept flowing. Debt kept expanding. Wall Street celebrated the boom while almost nobody stopped to ask what would happen if the environment suddenly changed. Then the environment changed very quickly. Inflation surged across America. Food prices climbed. Gas prices exploded. Rent increased. And suddenly the Federal Reserve was forced to react aggressively. Interest rates started climbing higher and higher at a speed Wall Street hadn't experienced in years. For companies carrying massive debt loads, borrowing money suddenly became far more expensive. Payments became harder to make. Debt became heavier. Businesses that had survived comfortably during years of cheap money suddenly started feeling pressure from every direction. And behind closed doors, executives inside private credit firms started seeing warning signs appear everywhere. Missed payments, stressed borrowers, companies quietly struggling to survive under rising debt costs. But publicly, almost nobody was talking about the risks yet. The financial media still sounded calm. The stock market still appeared functional. And most Americans continued living normally without realizing how much stress was building underneath the surface. And the perfectly smooth machine Wall Street had built over 15 years started making a sound nobody wanted to hear. A stress sound. The kind of sound financial systems make right before something breaks. Then in February 2026, something finally did. One of the largest private credit firms in America made a decision that quietly sent fear through Wall Street behind closed doors. Investors who believed they could withdraw their money were suddenly told they couldn't. The exits had been locked. And for the first time, many people inside the industry started asking a terrifying question. This was happening here. How many other firms were quietly facing the exact same problem? Then the announcement finally arrived. Not through a presidential speech, not through a breaking news emergency, but through a carefully worded statement from Blue Owl Capital, explaining that investor withdrawals would now face temporary restrictions while the firm managed liquidity pressures behind the scenes. And suddenly Wall Street started paying very close attention. The announcement sounded technical at first. Temporary withdrawal limitations, liquidity management, protection of long-term investor value. But behind the corporate language, the real message was simple. Too many people wanted their money back at the same time, and the system wasn't prepared for that pressure. For years, investors had been told these private credit funds were stable, safe, reliable, a sophisticated alternative to traditional investing. But suddenly, many investors were learning something Wall Street insiders had always understood. The money inside these funds wasn't sitting safely in cash waiting to be withdrawn. It had already been lent out through massive long-term private loans. And unlike publicly traded stocks, these loans couldn't simply be sold instantly during periods of panic. That's the hidden danger inside private credit. The exits can become crowded very quickly. And once confidence starts disappearing, pressure spreads through the system fast. Inside Wall Street, executives immediately understood the deeper fear, because financial crises rarely begin with giant explosions. They begin quietly. A liquidity problem here. A withdrawal freeze there. A few nervous investors somewhere else. Then suddenly everyone starts asking the same terrifying question at the exact same time. Can I still get my money out? And this wasn't the first warning sign. Back in 2022, Blackstone, one of the most powerful investment firms on earth, faced major withdrawal pressure inside its massive real estate fund known as Bright. Investors rushed to pull billions of dollars out. Blackstone responded by limiting withdrawals after redemption requests surged beyond internal limits. For many people on Wall Street, that moment felt deeply uncomfortable, because suddenly even Blackstone no longer looked untouchable. Wall Street had seen this movie before. In 2008, executives at Lehman Brothers and Bear Stearns publicly insisted everything remained under control right before the financial system started collapsing around them. Back then, many people believed the risks were isolated, contained, manageable, until suddenly they weren't. And by early 2026, some executives quietly feared private credit might be creating a similar type of hidden vulnerability inside the financial system. Because the private credit industry had quietly grown into a financial giant worth nearly $3 trillion, larger than the entire economies of countries like France or the United Kingdom. And much of that growth happened during an era of near-zero interest rates, endless liquidity, and easy borrowing. Now, the environment had completely changed, and firms across Wall Street were being forced to discover what their investments were actually worth under real stress. Federal Reserve Chairman Jerome Powell had spent years aggressively raising interest rates to fight inflation across the American economy. And every rate increase added more pressure onto companies already carrying enormous amounts of debt. Suddenly, refinancing became expensive. Borrowing became painful, and weak companies began struggling quietly behind the scenes. The problem wasn't necessarily that every loan was collapsing immediately. The real danger was liquidity. a boring financial word that suddenly becomes terrifying during periods of panic. Because liquidity means survival. It means being able to turn investments into cash when frightened investors demand their money back immediately. And when too many investors try leaving at once, even systems that appear profitable can begin breaking apart under pressure. That's what makes modern financial crises so dangerous. They often begin quietly, not with dramatic explosions, not with giant stock market crashes, but with small fractures hidden deep inside complicated financial structures most people never see until it's too late. Years earlier, JP Morgan CEO Jamie Dimon famously warned that when you see one cockroach inside a kitchen, there are usually many more hiding behind the walls. On Wall Street, people call this the cockroach theory. One visible problem often means other hidden problems still haven't been discovered yet. And by early 2026, many executives fear the industry had just spotted its first cockroach. This is the moment where the story stopped being just a Wall Street problem. Because somewhere in America, a retired teacher checking her pension account had absolutely no idea her future savings were connected to a private lending machine worth trillions of dollars. Pension funds, retirement systems, insurance companies, institutional investors managing the savings of millions of ordinary people had poured enormous amounts of money into these strategies, searching for higher returns. Most Americans never knowingly invested in shadow banking, but their retirement systems did. And that's partly why the story remains so quiet publicly. Because if average Americans fully understood how interconnected everything had become, fear could spread extremely fast. Financial systems survive on confidence. The moment enough people stop believing the system is stable, stability itself starts disappearing. So the language stayed calm, measured, technical. CNBC discussed the situation cautiously. Bloomberg framed it as stress inside alternative assets. Most mainstream media outlets treated the story like a niche financial issue instead of a warning sign inside a system holding trillions of dollars. But underneath the calm headlines, pressure inside private credit markets continued building month after month. And the deeper analysts looked into the industry, the more uncomfortable the numbers became. More stressed borrowers, more refinancing problems, more companies struggling under rising debt costs. The machine that once looked unstoppable was beginning to slow down, and Wall Street knew something extremely dangerous about slowing financial systems. Once confidence disappears, panic can move faster than anyone expects. Because for the first time since the industry exploded after 2008, private credit was finally being tested inside a high-interest rate world. And nobody truly knew how strong the system actually was. Financial systems survive on trust. And when trust begins breaking quietly beneath the surface, the consequences can take years to fully appear. The question is no longer whether stress exists inside the system. The real question is how much is still hidden. If you enjoyed this investigation into the hidden world of shadow banking, subscribe to Financial Arbitrage for more deep dives into the financial stories most people never hear about.